The Minnesota Office of the State Auditor presents Creating Tax Increment Financing Districts, an overview for TIF authorities. First, note that various development acts authorize the use of TIF, and TIF districts exist within projects that have their own formation procedures. We do not cover those processes in this presentation. Here we focus on the TIF Act provisions for the creation of individual districts within such projects. TIF authorities should seek legal and/or professional advice when making use of tax increment financing. A general overview of the process of creating a TIF district is illustrated here. It starts with the authority drafting a TIF plan. That plan must be given to the county and school district to give them the opportunity to provide comments and feedback. This must occur at least 30 days prior to a public hearing, which must be held after published notice, where the public can provide comments and feedback. After the hearing, the municipality may approve the TIF plan. To complete the process, a request for certification of the district must be made to the county auditor, who will certify the original value and set it up in their tax systems. Copies of the TIF plan must also be submitted to the Department of Revenue and our office, along with the TIF plan submission form to be discussed later. So starting with the TIF plan, statutorily required TIF plan elements include a statement of objectives of an authority for the improvement of a project, specific identification of properties the authority intends to acquire, a list of development activities for which the authority has entered into an agreement or designated a developer that identifies the parties, activities governed by the agreements, and expected dates of completion. Identification of other specific development reasonably expected to take place within the district and its expected timing. Estimates of costs and increment revenues, bonds to be issued, original and estimated net tax capacities, and the expected duration of the district. The authority's alternate impact analysis of the net tax capacities of all taxing jurisdictions. Identification and description of the studies and analyses used to make the but-for finding, and identification of all parcels to be included in the district. Note that there is a statement of position available on our website on TIF plan requirements that further describes each of these required elements. Some details about estimates of costs and revenues are important to understand. The TIF plan must contain 3 separate estimates of project costs, including administrative costs, interest as a financing cost, and tax increment to be generated. These are TIF-only estimates of what will be paid from tax increment. They should not include other sources or uses of revenues related to the project. The total of project costs and financing costs may not exceed, but can be less than, the estimate of tax increment revenues. These estimates establish the total authorized costs, whereby increments received in excess of these costs must be returned as excess increment. Here's an example of a TIF plan with TIF estimates that do not comply. This is terribly confusing and unclear. First, there appears to be both TIF and non-TIF expenditures, as a couple of line items are noted as TIF eligible, where others are not. In the first paragraph, there is a statement that total eligible TIF costs exceed $22.9 million, and this is the amount of pay-as-you-go payments. This does not correlate to any of the other amounts, and the expression of discounted dollars is not appropriate. The amount of administrative costs is buried in paragraph 2, but there is no way to identify total project costs to be paid from tax increment. There is also no way to identify an estimate of interest as a financing cost that will be paid from tax increment. The closest to a total estimate of TIF costs is found here, but again, this lacks separate estimates of project costs and financing costs. This plan does, however, seem to provide a total estimate of tax increment. This example does a much better job of complying with requirements. There's a clear estimate of tax increment. There's a clear estimate of project costs to be paid with tax increments, and no extraneous amounts of either non-TIF sources or uses. There's a clear estimate of interest as a financing cost. There's a clear total of project and financing costs, and this total does not exceed the total estimate of tax increments. They even provide a statement to this effect. They also provide a clear estimate of bonded debt. And by the way, bonds are defined in the TIF Act to include pay-as-you-go notes and interfund loans, and not just what you might traditionally think of as a bond. And you can see they recognize that here. It is also very helpful that their line items match the line items for annual reporting to the OSA. And we can see that their estimate of administrative costs is less than or equal to the 10% limit, which is something to be mindful of. When putting together a TIF plan and estimates of project and financing costs, understand that they are a key part of approval considerations, and they should be realistic. Costs that are greater than what is needed to enable a project may risk disapproval or cause a TIF district to tie up tax base for longer than what is necessary. Estimates that are too conservative may require future amendments, and the costs involved with another notice, comment, and hearing process, if the costs run higher. The estimates of tax increment that could be generated over a maximum duration is not necessarily a good starting point for identifying project costs. Most districts do not last their full duration or require that degree of expenditures. Focusing on what is needed to overcome the cost barriers that otherwise discourage development is a good starting point. It is also wise to consider what development is likely in the first 5 years, and to understand pooling limits that restrict what can be spent outside the district or for new costs after the first 5 years. Learn more about the 5-year rule and pooling from other resources on our website. Incorporating potential developments in later years may risk excessive pooling expenditures that violate those limits. When including an estimate of the duration of a district in the TIF plan, understand that the maximum duration limits in statute are counted beginning with the first receipt of increment, rather than from dates of approval or certification. And the maximum durations vary according to the type of district. For example, statute limits redevelopment districts to 25 years after first receipt, so that allows 26 years of collection of increment. An authority is also free to specify a duration limit that is shorter than the maximum duration, or the authority can simply decertify a district early when the costs are paid. A TIF authority may elect to delay the first receipt of increment by up to 4 years by specifying the first receipt year in the TIF plan. This is not allowed for economic development districts, however. The election is meant to avoid a minimal first year of increment from starting the duration clock, if that is an important consideration. For example, if a TIF plan were approved on June 2nd of 2022, and the request for certification occurred before July 1st, and the construction was set to begin in the fall and finish in the summer of 2023, we can see 2 possibilities for less than full increments. Pay 2022 would be the base year based on assessment year 2021's January 2nd assessment date. No new construction value would show up in the January 2nd, 2022 valuation, but if that value had increased due to market conditions, some minimal increment would be generated for taxes payable in 2023. Taxes payable in 2024 would also reflect partial increment due to construction being incomplete by the January 2nd, 2023 assessment date. Pay 2025 would likely be the first year of full increment if things proceed according to plan. An authority could elect to set 2025 as the year of first receipt of increment, and this would skip increment collection in 2023 and 2024, and make 2050 the maximum duration limit rather than 2048. Note, we'll discuss later the timing of the certification request and how that can affect the years of increment. Again, if an authority expects not needing the maximum duration, this may not be necessary, but it is available as an option. Okay, let's talk about the approval process. A TIF plan must be approved by the municipality in which the district is located. So, if the TIF authority is an HRA, an EDA, or a port authority, it must request municipal approval. The plan may be approved only after a public hearing and published notice in a newspaper of general circulation in the municipality at least once in the period 10 to 30 days prior to the hearing. The published notice must include a map of the district and project areas. There are also required notifications to the county and school district required at least 30 days before the public hearing to allow them opportunity to comment. After the TIF plan is drafted, and again at least 30 days before the public hearing, the authority must provide the county auditor and school board clerk the proposed TIF plan and the authority's estimate of the fiscal and economic implications of the proposed TIF district. The fiscal and economic implications of the district include an estimate of the tax increment to be generated over the life of the district along with the shares attributable to the county and school district levies, a description of the probable impact on city-provided services, public infrastructure, and the ability to issue debt as affected by the issuance of any general obligation TIF bonds, and any additional information requested by the county or school district by written policy or otherwise regarding the size, timing, or type of development. For housing and redevelopment districts, an authority must also give a separate 30-day notice to and offer to meet with the county commissioner who represents the area in which the TIF district will be located. Although a municipality is not bound by most feedback, a municipality should give it fair consideration. There is one possible demand that a municipality must comply with. Counties may require certain road costs to be included in the TIF plan and paid from tax increment. They have a 45-day period to assert this option, which, by the way, could create a timing issue and require an immediate modification if the municipal approval comes right after the required 30-day notice. So a 45-day notice may be worth considering to avoid the costs of a modification. Although not part of the comment feedback process, one other county-related item worth mentioning quickly is that a county may bill the TIF authority for their TIF administrative costs. So be aware that these costs may arise and can be paid from tax increment. Before or at the time of approval of a TIF district, the municipality must be able to make certain findings and set forth reasons and supporting facts for each determination. The first of these findings are required findings for the type of district being considered. They include blight findings for redevelopment and renewal and renovation districts, public interest conclusions regarding jobs and tax base for economic development projects, and pollutant and cost criteria for soils condition districts. Housing districts lack an explicit finding of purpose, but must be found to meet qualifications. The consideration of whether a project meets a public purpose can be an opportunity to weigh broader merits and concerns beyond these narrow requirements. Perhaps the most critical of the required findings set forth in statute is what is generally known as the but-for test. A municipality must be able to find that, in its opinion, the proposed development would not reasonably be expected to occur solely through private investment within the reasonably foreseeable future, and, for a district other than a housing district, that the increased market value of the site that could reasonably be expected without the use of TIF would be less than the market value of the proposed development after subtracting the present value of projected increments. In other words, the additional value created by the use of TIF must exceed the value of the investment of tax increment. Why is the but-for finding so important? The conceptual merits of TIF hinge on the but-for test. TIF is meant to overcome market failures and enable future tax base that otherwise would not exist. If development would occur without TIF, then the use of TIF becomes a subsidy that diverts tax base and has negative impacts on taxpayers. If development would not happen but for the use of TIF, it has little or no negative tax base implications in the near term and positive implications in the long term. Moreover, the use of TIF is a municipal decision. The tax bases of county, school district, and all other local taxing jurisdictions all see their tax base locked at the original value for the duration of the district. The but-for test is not simply a box to check. It is a subjective analysis that warrants careful consideration. The first part of the but-for finding, after all, is unlikely to be a black and white test, where you can conclude with certainty that either no development would occur without TIF or the proposed development would surely occur without TIF. These are judgments that must be made about what would reasonably occur absent the use of TIF over a time horizon of up to 26 years. Perhaps only some modest or undesirable development could be expected to occur late in the time horizon, or perhaps a nearly comparable development would likely follow quite soon. In between lies increasingly nebulous possibilities. A model of the TIF concept helps illustrate. The general premise from its redevelopment origins is that a property might be blighted, where its value is declining or stagnating, and this is expected to continue absent any public intervention or assistance. When a TIF district is created, the original value at that point is established or frozen as the tax base for the duration of the district. With the public financing of TIF in place, development is enabled and the value increases as a result. The tax rate is still applied to that captured value, but those taxes are segregated as tax increments and are not part of the tax levy. When the TIF district ends, taxpayers then realize the public benefits of the endeavor, as new tax base is available to support local levies. The captured value that provided the tax increment is generally viewed neutrally as the investment that made the benefits possible, rather than negatively as economic loss, given that the development would not have happened but for the use of TIF. But what if this starting assumption is not true? What if the proposed development would occur without the use of tax increment? The conceptual justification disappears, and when the TIF district is created, the freezing of the tax base for the duration of the district and the capturing of value to generate tax increment represents an economic loss, where the tax base that could have supported local levies is instead providing a subsidy to the development. This illustration highlights a worst-case scenario where the proposed development would happen without TIF. Perhaps a more common possibility is where, absent the use of TIF, a different development of lesser value would occur later during the TIF district's timeframe. In such a scenario, the start of the TIF district effectively leads to a higher value development, and the capture of value and increment is neutral until the point at which the value that would have existed without TIF begins to represent an offsetting economic loss because it would have been available without the use of TIF. In the end, there is public benefit, but it is offset to some degree by the intervening economic loss. These models do not account for the immediate benefits of jobs and economic activity, but they do help illustrate the effects taxpayers may experience and the importance of making a studious assessment of the but-for finding. The TIF Act requires 3 additional findings when approving a TIF district: that the TIF plan conforms with the general plan for the development or redevelopment of the municipality as a whole, that the TIF plan affords maximum opportunity consistent with the sound needs of the municipality as a whole for the development or redevelopment of the property by private enterprise, and, if located in a fiscal disparities area, the municipality must elect the method of tax increment computation. In short, the Fiscal Disparities Program requires a portion of new commercial and industrial value to be shared area-wide, but this conflicts with a TIF district's capture of that same new value. So 2 choices exist for tax computation. With option A, the default, a TIF district captures the new value and receives full increment. The fiscal disparities contribution, therefore, comes from the existing tax base, causing taxpayers to shoulder extra burden. With option B, the fiscal disparities contribution is made from within the TIF district, holding taxpayers harmless, but reducing the capture of tax increment. This is an important consideration when creating a TIF district for municipalities that lie in the fiscal disparities areas. As an FYI, when option A applies, the increased property tax imposed on other properties as a result of the contribution to fiscal disparities coming from outside the district must be shown on an annual disclosure that is required to be published. Instructions for the option A tax increase calculation are provided by the Department of Revenue on its website. One last mention about these various findings. They are not all explicitly required to be included in TIF plans, although the documentation of the but-for finding must be identified in the plan. They might just be part of the resolutions for approving the district, but for documentation for future staff, it is a good idea if these elements can be included in the TIF plan. One additional consideration in creating a TIF district, which must be included in a TIF plan if used, is a seldom used option regarding the capture of value. An authority may share a portion of the new value with the tax base rather than capturing the full increase in net tax capacity. For districts that are unlikely to need the full capture for the full maximum duration, this could be an attractive option. This feature actually introduces some new terminology. It might be evident that the difference between the current and the original net tax capacities is the amount of captured net tax capacity. The opportunity to share captured value creates a new term, the retained captured net tax capacity. Again, however, this option to share value has very seldom been used, probably because it might be more appealing to capture the full increment and end the district as early as possible, rather than risk some unanticipated shortfall and insufficient increments. To better explain, let's look at the conceptual models again. If an authority chooses to share 20,000 of the 64,000 of captured net tax capacity, for example, rather than retaining that full captured value, The frozen tax base is essentially raised to include that shared net tax capacity and represents some immediate public benefit that will be enjoyed for the duration of the district. The risk here is whether the diminished tax increments on the remaining retained captured net tax capacity will be sufficient should the growth in value end up being less than projected due to the actual scale of development, market conditions, or legislative changes that impact property taxes. It's not unusual for actual activities and values to fall short of estimates. This is why most authorities choose not to share value, and a more attractive option may be to make full capture, and then, once the captured increment has been sufficient to cover the necessary costs, decertify the district early. This is consistent with the 5 and 6 year rules direction to identify the core in-district costs in the first 5 years, and then to decertify once sufficient increment is available to pay those costs. The idea is to limit increment capture to what is needed, and to achieve early decertification and enjoy the benefits of the expanded tax base as early as possible. After the municipality approves a TIF plan, the authority must take several steps in completing the process of creating a TIF district. First, an authority must request certification of the TIF district by the county auditor. This is where the county certifies the original net tax capacity of the district. The timing of the request is another decision point for an authority, as it does affect which year's values are the base year, and therefore when first increment might occur. Any request made through June 30th will make the prior assessment year's value the base year, meaning increment could start as soon as the next year, while any request made July 1st or later will make the current assessment year the base year, where increment could start as soon as the year after next. For example, a request on June 30th, 2022 would make assessment year 2021, which is the value used for taxes payable in 2022, the values used to set the original net tax capacity, or ONTC. This in turn means that increment could start as soon as 2023. A request made on July 1st, 2022 would have the original values be based on the 2022 assessment year. First increment would be possible as soon as 2024. As we noted earlier, increment is possible due to market changes and not just based on when construction begins. The format of a request for certification is up to the discretion of county auditors. There may be a few counties that have their own specified format for a request for certification, although most do not. Generally, you would contact them by letter or email and send them a copy of the TIF plan. But it has also been a long-standing practice to highlight key details in a supplemental document. For many years, the Department of Revenue has supplied a certification supplement to highlight those key details, but they've discontinued doing so in recent years. The OSA has developed a supplemental document that we recommend using absent any county-specified form. This form highlights information like the type of district, whether special laws apply, whether there's an election to delay first receipt of increment, whether a shorter duration is specified, the fiscal disparities computation method, and other details that are important for the county auditor to know, but might be easily overlooked when sifting through a full plan document. TIF plans must also be sent to the OSA and to the Department of Revenue. Submissions to the OSA are done online and must be accompanied by a TIF plan collection form. There are separate TIF plan collection forms for new districts and for submitting modifications of plans for existing districts. There is assistance on how to use SAFES on our website, or you can contact the TIF division if you have questions about this process. Like the certification request supplement, the TIF plan collection forms collect all the important data found in a TIF plan, and the plan itself, along with other supplemental information like approving resolutions, should be submitted along with it in a single PDF. TIF plans should be submitted as soon as possible, but the statutory deadline is to submit them within 60 days of the latest of 3 dates. The request for certification, which is almost always the latest date, or municipal approval, or the authority's plan adoption. And this concludes our overview of the TIF district creation process. Please refer to our website for additional videos, articles, and other resources, or contact us with any questions you may have. Thanks for watching.